What's up, everybody? Jonathan Rose, owner, Masters in Trading. Pretty crazy trade. Yesterday, the market started breaking. The market started falling right here. I went in and bought 200 SPY options that expire in 1 day. These were selling. They were offered for 15 cents. I just went in there with one ticket, bought 200, risked $3,000 for one night. And now I'm up about 20,000 plus. If we cover them at an average of $1.50, that's a $30,000 winner on $3,000 that was invested 1 day ago. I'll show you exactly how I did it and the tool that I used to find this trade. Let's get into it. All right, so let me just start here, guys. Here's Thursday. Today is Friday. We had non-farm payroll. Yesterday, the market started falling. I bought 200 SPY, September 335 strike for 15 cents, and I did that at 9.50. So I did it right here. It's not that I caught the high. These are the S&Ps, 3570. So the S&Ps already fell 70 points, but the market was moving really fast. And the VIX was exploding higher. So I'm going to show you the VIX tool. It's a proprietary tool that we use at Masters in Trading, and it compares VIX term structure. So here's the VIX tool. The VIX tool gives buy signals and includes a back tester, but that's not what we're going to cover right now. What we're going to cover is these 4 lines. Those are 4 different time frames of volatility. So we have the bright red, which when the pandemic hit was out of control. That's a 9-day measure of volatility. We have the yellow, which is a 30-day. That's the traditional VIX. We have a 3-month measure of volatility. The white, that's a 90-day. So we have 9 days, 30 days, 90 days, 1 year, 365. Now, in a normal environment, in a normal low volatility environment, long-term VIX is going to be the highest, 365 days. Short-term is going to be the lowest because when everything is good, we know what's going on in the next 9 days, but who knows what's going to happen in the next 365. But at the height of the pandemic, when everyone's really scared, the short-term, the 9-day exploded higher because who knew what was going to happen in the next 9 days? The market was kind of saying, hey, 1 year from now, we're going to be fine. Things are going to be okay. But who knows what's going to happen 9 days from now? So that's when the pandemic hit. Things started to go back to normal. 9-day was under the 30-day, under the 90-day, and under the year. But what happened yesterday and what got me into that trade was 2 things. For one, all the long-term VIXs started rallying. And they start rallying because the election's coming up, and with the election is going to bring more uncertainty. But it wasn't until that 9-day started rallying. And the 9-day, again, today is Friday. The 9-day started rallying on Wednesday. But Thursday, it started to overtake the 30. And it started to get above the 100 period moving average. So once those 2 things kind of aligned, I was comfortable buying very short-term spiders. But the other catalyst, and this kind of didn't work, but it kind of did work, kind of didn't, kind of did, non-farm payroll. We had unemployment today. So unemployment, is it going to be bullish? Is it going to be bearish? I have no idea. I'll leave that to Goldman Sachs. But what I do know is non-farm payroll is a volatility catalyst, which means it's not like your everyday Friday. It's not like your everyday Tuesday. There's a number that's coming out that's going to greatly move the market. Now, non-farm payroll actually ended up being pretty good, not terrible. So what happened? Non-farm payroll right here, the number's not terrible. It rallied, but the market's weak. It rallied, it was weak, followed through to the downside. Now, looking at the trade, long 200 from 15 cents. Now, the best I saw these get to were maybe $3. I was kind of bummed that I missed out because at $3, I was up about 85,000 on this position, but the market was moving very fast. We didn't have a lot of time to get out of the position down here. So yesterday I covered a little bit. I covered 30 of them for 75 cents. Then I started covering 65 cents, $1.10, $2.10, and I'm still long 90 of these. We'll see what happens. We still have about 3.5 hours to the close. I've locked in enough profit that I'm definitely not going to lose money. I think worst case scenario, I'll probably still make 10 or 15 grand. But if the market keeps selling off, we can go back and we're making 30, 40,000 on this very, very kind of straightforward. Now, I don't recommend it for everybody. It's high risk, high reward. But just looking on the short term, you can see here's that 9-day. 9-day spikes higher, starts to overtake the 30-day. And that gave me the confidence. You could even look 9/3 at 9:30 a.m. We're right about here. And then at 10:30, we're right about here. And that's when I finally got into the trade, was willing to risk $3,000. I was comfortable losing $3,000 if this didn't work. But again, I had the short term and I had that major volatility catalyst the next day. So that's why I was comfortable doing it. Did it work? It worked. Did I crush it, annihilate it? No. I thought yesterday if there was any kind of poor unemployment number, I was going to make over $100,000. But still being able to lock in over $20,000 on one day with $3,000 of risk, we like to say it's better than a sharp stick in the eye. Thanks for watching. My name is Jonathan Rose. I'm the owner of Masters in Trading.